Welcome to Market Watch. With me, I have PiFund's CEO and founder, Mike Taylor. Today, we are talking about the currency storm on global financial markets. Hi, Mike.
Hi, Len. How are you?
Big currency storm hitting all the dollars and currencies around the world, but really emanating first and foremost out of the US. Can you recap us on what's happened there to really send the rest of the world spinning?
Yeah, well, I definitely know it's a big move because I've got all my non-financial friends reaching out to me saying, "Oh, what's happening with the dollar?"
Yeah.
So essentially, you know, the US dollar is the strong currency at the moment, and everything else is moving against that. I mean, we can talk a little bit about the pound. They've got some separate issues, but broadly speaking, it's the dollar that's strong. And why is the dollar strong? It's because the aggressive or the hawkish stance of the US Federal Reserve and hiking rates.
So that all comes back to that inflation story. They're moving, like us and like other central banks, to get on top of inflation by putting rates up. But I guess the US dollar is still sort of supreme in the world, and they're going to sort of be front of the queue in terms of dealing with inflation. We all sort of have to wait until they hit their target.
Well, they're probably quite happy to have a strong dollar because that means that they can sort of export the inflation elsewhere, because it means, you know, filling up the cars is cheaper and other imported expenses are cheaper for them. So I'm sure the Fed is reasonably pleased with the strong dollar policy. Not so easy for the rest of us around the world, though, because it means that our costs go up.
Yeah, so that inflation story, dealing with inflation gets tougher around the rest of the world. New Zealand, our currency has been hit, but in relative terms, probably, not among the worst. I mean, you mentioned the UK. They've obviously taken a real fall. I mean, I've seen it's the lowest since 71, but actually that makes it the lowest since 1792 or something ridiculous, doesn't it?
Yeah, it's probably the weakest the pound has ever been in history. And it's sort of over a 2-year period against the US dollar, it's gone from sort of 170 down to almost now parity. It's quite extreme. I mean, but the UK has had its problems, starting with Brexit and a particularly tough time the last couple of years as a result of that. Then we've had this sort of upset in the political sphere with them. And then more recently, we've had a new Prime Minister elected, and they've come up with a bold plan to try and stimulate the economy. However, investors and markets haven't been happy with that because the plan is effectively what we call unfunded. So they've said, great, we're going to cut taxes, but sort of how are you going to pay for that? We're going to pay for it with more debt. And we're in a situation with rising interest rates, which will not be good for them.
And all the debt left over from COVID to deal with as well.
Exactly.
And I guess, I mean, just on the UK, that idea of cutting taxes, even if you believe, yes, that could fire up business, it's going to take a while to fire up business and generate that wealth creation. In the meantime, the central bank, the Bank of England, is left dealing with another crisis. They're having to print money again, effectively.
Yeah, I mean, it's working against what the Bank of England is trying to achieve, which is obviously trying to bring down inflation without putting the economy too much into a recession. But what they've had to do in the last 24 hours is actually go back into the market and start quantitative easing again, buying bonds to stop the bond yields from accelerating too high. So, it's a crazy situation.
Yeah. Well, it's worth mentioning here that you've actually just come back from the UK and Europe, where you've been looking at the economies there and how their companies are performing. I mean, what was your big takeout for I guess, two different parts of the world now that they've separated? But
yeah, I mean, we've got an office in London, and the team there was not very pleased with the announcements regarding the tax cuts, even though it probably would be beneficial to them. And I spent quite a bit of time in Germany, and it's a good place to have been because it's the epicenter, I feel, of the slowdown, because you've got Germany so heavily reliant on Russian gas, and that's effectively being cut off now. So a lot of the companies that I met with were actually talking about alternative ways to generate heating within whether it be in the offices or the factory. Almost a situation where one company I met said they spent $100,000 buying sort of oil heaters.
Wow, yeah.
To enable the factory to keep operating. So for them, it's extremely important, and it's quite scary that they might have an energy crisis on their hands. However, a lot of those businesses also have interactions with the US or customers or suppliers in the US, and it seems to be the US was doing quite well still. particularly had a meeting with Lufthansa, who was saying that actually their transatlantic flight and the US, people who want to come to Europe for a holiday is actually really, really strong at the moment, which is not surprising when everything's suddenly got 20% cheaper for them.
Yeah, that's right, and not necessarily a bad thing for New Zealand in terms of attracting tourists back into the market.
Yeah, if we can get those flights from New York to make it here in one go, then
the wins are fair for New Zealand. Well, let's bring it back round to equities if I can. So not front and centre of the story, Wall Street and shares right now, but they've actually been hit quite hard in this. I guess as sentiment comes off. We've talked over the last few episodes about being cautious because this rebalancing still has some way to play. I mean, I guess that plays into that outlook for you.
Yes, I mean, looking at the situation, I think for equity investors, it'll be different in terms of trying to find a bottom versus the last couple of bear markets in 2000, 2003 and 08, 09, where we sort of waited for the bottom to fall out of everything, interest rates to go down to zero before it was sort of appropriate to get back into equities. This time it's much more, we're here because of inflation. So we should be looking for signs as to when inflation has peaked. It's quite possible we've kind of reached peak inflation fears anyway at the moment. So what the next step would be is that when central banks feel comfortable to pause their rate hikes, and it could potentially be a point at which markets may bottom.
Sure.
Even though this might still be some pain in the real economy, markets might say, well, no, we're going to look through that, just like they looked through the pain through COVID and say, inflation's dealt with.
Once rates are in place.
Yeah.
And I guess, the reminder this week is that it really is US inflation that's going to be at the front of that.
Yeah.
And that's where we've got to look, over the next few months of announcements.
That's right. I mean, I think coming into the year end, when a lot of central banks have said they'll get to a level where they might be ready to pause, that would be quite a crucial time for equity markets.
That's great. Okay, we'll leave it there. Thanks, Mike. Cheers.